So look, today I'd like to focus on the goals that you guys have for your clients. So what do your clients want? They want strong and consistent returns, but almost as importantly, lower risk through lower drawdowns and better diversification. Global small and mid-cap companies, I think, bring to mind higher returns, but for most of you, they'll also bring to mind higher levels of risk. I'm here to tell you today that the risk-adjusted returns of small-cap stocks have historically been excellent, and the other key point is that currently the multiples on these small-cap companies are significantly lower than they have been historically, and that's due to strong large-cap driven returns driven by Mag 7 stocks. So the presentation will be structured around three key points. That's that small and mid-cap companies do deliver high risk-adjusted returns, yet are priced today at record relative discounts to large caps. The Antipodes industry-led research approach works in this space. We're a 30-strong investment team. We're not a handful of people picking stocks. And so far that has delivered a track record of alpha since the strategy inception, but also in this asset class since the inception of the business 10 years ago. So the fund performance to date is around 20% per annum, around 7.5% in excess of the benchmark. But most critically, it's delivered the trademark Antipodes risk management that you see in all our global funds, which is a superior Sharpe ratio, that is risk per unit of return, much better than the benchmark, and also strong capital preservation, where the drawdowns have been 72% of market indexes, reducing your risk in periods of stress. And again, the portfolio is very diversified, which we think reduces risk without sacrificing return. So what's the long-term record of global small and mid-cap companies? Well, as you can see, in Australia, the record is roughly in line. But when we look globally on the MSCI World Index, but also the S&P 500 in US stocks, small and mid-cap companies have delivered strong performance over the very long run against larger cap peers. And the return is also excellent in an absolute sense. Most importantly, at the index level, you have been compensated for your risk. This is evidenced by a much better Sharpe ratio globally and in the US. I'd also point out that this is true in other markets. It's true in the UK, it's true in Europe, it's true in Latin America, it's true in Japan, it's true in Asia ex-Japan. It is an asset class that on a risk-adjusted basis has delivered excellent long-term returns and compensated you for any extra risk in terms of extra return. Okay, so there's a but. And the but is that the asset class has lagged the large cap Mag 7 driven industries significantly recently. I guess I'm here to tell you today that that's the opportunity. In 2018, lots of things happened. There was the Brexit negotiations, Trump inauguration, same-sex marriage plebiscite, but also we can see that large cap companies, the multiples on large cap companies started to diverge from small cap companies and traded at a higher multiple. As you can see today, they're now trading at roughly double the multiple of small and mid cap companies. In terms of why this is the case, is it geographic? No. Both indexes have roughly the same level of US stock exposure. And what's happened is, as you'll know, growth has diverged, but how far has growth diverged? On a 7-year look back and 3-year forward estimate basis, the difference in growth is about 1.5%. So we think that level of difference in growth isn't reflected in current multiples, and the starting point of small and mid-cap stocks, which is roughly a 6% earnings yield, provides an outlook for strong double-digit returns with a little bit of growth without any multiple re-rating. So now is the time to be adding small and mid-cap companies to your client portfolios. They're cheap, which means more likelihood of upside and also lower likelihood of a re-rating down. Why are Antipodes well placed to deliver small and mid-cap alpha? Firstly, 10 stocks are over 20% of the global indices. In small and mid-cap companies, that's under 2%, closer to 1%. So you have a very rich opportunity for stock selection-based decisions. And how do we do that at Antipodes? We do a lot of industry research. Research on change, research on structural change, on cyclical change, on socio-macroeconomic change. We know what Amazon is doing. And if you want to invest in retail, in a retailer that competes with them, you need to know what Amazon is doing and where they're attacking your business. Can you stand out in that competitive environment? We follow what's happening in commodities markets deeply. We have major insights into big pharma that helps us see trends that we can play in smaller pharmaceutical companies. When you know what your major customers are doing, what your suppliers are doing, what your competition is doing, not only do you get better money-making opportunities, but you make better investment decisions that avoid loss-making. Loss-making investment decisions in value traps, in growth traps, and other forms of change that can affect your initial investment decision. Here's 3 industry examples that leverage our 30-strong investment team, and we think provide a good example of why that larger team and industry-driven approach provides competitive advantage over a smaller team picking stocks. The 6 stocks in the boxes below have averaged in excess of 100% returns for our investors since inception, and are great examples of that advantage. So we have ASM International and Square, 2 companies that have benefited hugely from AI. ASM International is in the semi-equipment category, and Square is a play on the dominant memory company. We think these will be able to grow with AI for many years. In financials, we've owned Nubank, which is the leading retail bank, disruptive retail bank in Brazil and now Mexico. It's now the largest retail bank in terms of its customer base in those markets, and it's generating a 45% return on equity with only a 30% loan-to-deposit ratio. A more cyclical opportunity was UniCredit, a bank that was earning 3% return on equity in the low-rate environment. Unusually, what happened in Italy and what came through the industry research process was that, like most banks in most countries, they were passing on interest rate increases, but that market had a unique structure whereby they didn't pass on rates to deposit holders. And so return on equities moved up above 20%, and it's been a significant winner for the fund. In pharmaceuticals, we have 2 PhD research scientists on the team. And some examples here are Structure Therapeutics, which we've owned. It has an oral-based GLP-1, as opposed to the injectables that are starting at the moment. And we think that going forward, when we take a longer-term view, people, particularly those focused on weight loss rather than the diabetic aspect of GLP-1s, people will prefer an oral drug. And we think it's a company that a lot of the large pharmas would like within their portfolio and a strong acquisition target. Alnylam's been a winner in terms of cardiovascular research, again coming through the industry process and having a clear understanding of what the larger companies are doing in this sector and how this company was placed. So these examples, I've given sort of 3 industries, but they're true across the portfolio. Since inception, Antipodes Global Opportunities Fund has positive alpha in 10 of the 11 global GICS sectors. So rather than picking winners, we're picking winners and anomalies in industries because we have industry specialists covering the global market cap. So yes, this process identifies the opportunities that I've shown above, but as I mentioned earlier, it's just as critical investing in smaller companies that you need that peripheral vision. You need to be focusing on what's happening in the industry more broadly, on the suppliers, the competitors and the customers, and that process also reduces risk. So a couple of examples in the portfolio at the moment. We love dominant global supermarket chains. Very simple industry in terms of the way the industry works. You have significant advantage and scale in buying power. You reinvest that buying power into lower prices for your customers, which drives competitive advantage and market share growth. On the slide, we've got two mega cap companies, Walmart and Costco, that we think are actually quite equivalent in the business model sense to the two smaller companies that we own in the fund, Sendas, which is equivalent to Costco in Brazil, and Tesco, which is equivalent to a Walmart in the UK. Walmart and Tesco are both hypermarket companies. They're both over-indexed to e-commerce. So as we move from e-commerce being the lowest, grocery-based e-commerce, having the lowest penetration of e-commerce of any sector, to becoming more common, both these companies increase their market share significantly. The difference is the starting multiple is less than half for Tesco than it is for Walmart. In terms of ERP or accounting software, it's another great industry that we like. These are very sticky businesses. You don't move your financial systems unless you have a very good reason to do so. Most of the market leaders in this sector have done very well over the recent period of time. But when we look globally, we see King D in China standing out as a unique opportunity at the current point in time. So there's a couple of things driving this. First of all, we know that the US is internalizing and reducing a lot of Chinese imports. China's doing the same. China wants to make its software sector more domestically driven, and they're pushing out the foreign competitors like SAP. King D competes in that large company enterprise space, and he's taking market share rapidly. Secondly, the growth drivers globally have been that switch to cloud. And whilst most of the globe is 30 to 80% penetrated in terms of cloud, King D and the Chinese opportunity, particularly in that smaller company sector, so they also compete right down the bottom like Xero with very small companies, the penetration is more like 15%. So a very long runway of cloud-driven expansion. When we look at the growth rates, the company's grown at 15%. Currently, we think that's incredible in a very weak macroeconomic environment, and we think the company can grow 15 to 20%, most likely for the next decade. It's trading on 2.5 times sales. These businesses typically reach 40% margins at some level of maturity. So the forward outlook for expected returns, again, here is fantastic. In terms of a quick look across the portfolio, the thing I'd point out here is Frontier was the largest position, or still is the largest position in the fund, attracted a 40% takeover at a 40% premium last week. Again, driven by industry research, that Verizon, the largest US telco, needed to get into fixed line broadband internet, and that's what Frontier does. In terms of the returns since inception, as mentioned previously, they've been strong, great upmarket capture, great downmarket capture, and very strong Sharpe ratios in terms of risk-adjusted returns. It is a diverse portfolio globally, which we also, again, think reduces risk. So in summary, small and mid-cap companies deliver higher risk-adjusted returns that your mum and dad investors want in the long run. They're currently at record discounts to large caps. Antipodes' approach of industry-led research is unique here, and it works. We're a 30-strong investment team analysing sectors and industries deeply, rather than a small team of stock pickers. We have a demonstrated track record of alpha since the strategy inception, and I'd encourage you to assess the opportunity for the vast majority of your clients. Thank you.